Well, it took a while to get here, but the Fed finally cut interest rates last week. U.S. and European share markets reacted positively to the FOMC policy directive for a 50 basis point Fed funds rate cut. And this was last week's main event. Today we're talking on the 26th of September with our chief equity strategist and economist, John Blank. He's going to give us some analysis of this whole event. John, why 50 basis points, not the normal 25?
It's a really good question, Terry. I think the Federal Reserve Chairman talked a lot of people onto his side of that debate. It wasn't unanimous for the first time in a long time, and I think it's just his way of reaching quicker to conditions outside the United States, particularly in Europe, the BOE and the BOJ, that we're facing some pressure, and it inadvertently, or maybe it advertently, depending on how you want to look at it, it brought the Chinese stimulus into play as well at a higher level. So I think at this point, he's probably pretty pleased with himself that he did it.
I called it the main event last week. How consequential, actually, was the move in the overall scheme of things?
Well, the thing that's interesting is, really the 10-year Treasury is reflecting conditions in China and Chinese bond market and all that. And all the short end did is it moved down 50 basis points, 4.87 from 5.33, draining some money market funds, but it put the stock market higher, which, creates a wealth effect. And, it will take a long time for it to play itself out and not be very strong. But in general, it's unlikely that he's going to get the mix of things he wants, which is lower inflation and stabilization and upgrade in jobs. That's the problem here, is he's kind of pitching that he's after, reversing the job slowdown, but he may well have to deal with having prices turn up with the jobs pickup. And that's really the issue here.
Yeah, I'm going to get back to that in a minute. Which areas of the economy is going to be impacted by this cut?
Really, it's the housing market that's the critical thing that will change, because when you look back to where the housing starts moved down, it's definitive. It moved down when he started hiking rates. So he took residential fixed investment down at the same time the fiscal policy took non-residential fixed investment up. So residential and fixed investment went down, non-residential fixed investment went up, and now both are going to be charging up. So really, we'll see how many jobs come through that multiplier effect of the housing market, but that's the main thing he did.
So let's circle back to something you alluded to a moment ago. How do you think this is going to impact the future path of U.S. inflation?
Not in a positive way, Terry. I think it's going to slow down our downward disinflating progress to some degree, and that could extend out the amount of inflation, which people think is not a problem for stocks, but it may well turn out to be one. So the jury's really out, and it's going to be out for a year and a half on whether the entire path of Fed fund rates is appropriate, and whether they really do achieve their statutory mandate of getting both 2% inflation and a stable jobs market in hand a year and a half from now.
So here's the big question then. With this cut, has the Fed actually won the war on inflation here?
The answer is no, Terry. The Fed has not won the war. And that's my issue here. And that was the issue of Michelle Bowman, who dissented. Leaving the game of inflation at 2.5% because you think it'll be 2% or lower in a year from now is a bet. It's no guarantee there, Terry. And when you roll lower interest rates in the face of that, you make more upward pressure than downward pressure on that bet.
You've written recently about a soft landing in the economy, and based on what I'm hearing from you, it's seeming like this rate cut is not going to help with that.
It will help with that, Terry. The soft landing that it will create, which is the main worry now, is the jobs market. It will raise housing market-related jobs, which are a lot more extensive than you might understand: appliances, air conditioning, remodeling, second homes, vacation homes, things like that, all come up with this situation, as well as changing the dynamics of the multifamily apartment rental markets. So that will improve the job market, and that is where he looks to stick a soft landing, because at this point, soft landing is boiling down to not having a huge run-up in unemployment. And that is kind of what he's doing. And like I said, he has two mandates, not one, and people are suddenly deciding he has one.
Does this alter the Fed's policy outlook going forward?
Yes, it will keep altering. I mean, it's not, I think the market read December meeting is like this, great watershed event. It certainly was a rate cut, and that was important, but they do go to meetings and they do offer new summaries of economic projections quite often. And those are all events where they update us. And so there will be other events for, the next 2 years as they continue to adjust their forecasts.
How might this affect the policies of other central banks?
Well, we've seen, like I said, the big thing that surprised all of us as economists is this People's Bank of China was sitting on the sidelines quietly watching the Fed, and they moved aggressively after it was over. So the real news is the global economy got a big bid, and that is something that the Fed wasn't really banking on, although they could have banked on it in some respects. But that does help the Fed, I think, more than hurt the Fed.
Volatility in the market marked the month of September leading up to the rate cut. Do you see investors now less on edge in the weeks ahead because of this?
No, I think investors will start pricing in. They're already priced in 2026. So I think what's going to happen quickly as the election disappears is the market's going to decide whether it agrees with 2026 during an earnings season that's going to have played out. So I think the surprise might be the market looks beyond the election of 2026 and makes its own set of decisions than that it looks at right now.
Okay, a few strong buy stocks you're watching include Takeda Pharma, Naspers Limited, and Packaging Corporation of America.
Yeah, Takeda Pharma, I've got it at $14.58 per share today. It's the number one ranked stock with an A for value and a D for growth. Why I want to point this out is a big pharma stock, and pharma is our top 35% industry. And you can pick this one up with a nice dividend at 3.3% annually. So as the Fed cuts rates, what you can go into is a large cap pharma name in a really beaten down market like Japan. You got a price earnings ratio of 9 versus the 20 to 24 of the S&P 500. So you got a much safer value play here. Of A for value, if you're a long-term investor, this is the name to look into.
Okay, Naspers Limited.
Naspers Limited. So you don't know this name. It's a South African conglomerate, very old actually. National Press is kind of a concatenation of what that is. It was a real early printing company 100 years ago. But what they did when the internet came around 25 years ago is they started buying internet companies, and they did what is considered one of the best venture capital investments ever. They bought 30-some% of Tencent, the big Chinese conglomerate in the mainland of China that is in the FXI, and a very important stock there. So now with the Chinese stimulus, you have these Naspers shares listed in Amsterdam in the Euronext. But the underlying fundamentals that are ratcheting up, they're up 12% for next year and 10% the year after, all because of Tencent primarily, are going to go up even higher. And you've got a nearly nice trade on a stock that's not listed in China for Chinese growth.
And Packaging Corp of America.
Packaging Corp of America is in Lake Forest, Illinois, Terry, near you. Price is $214 a share. The target price is $232. Just want to point out that if you bought this stock middle of last year, it was $130 a share. So what's the issue here? The issue here is the same that we see in the U.S. stock market. It's a number 2 ranked stock, but the price earnings ratio on next year's earning is 24.6. And that is the problem here. It is a very pricey stock. It can easily go, on a corrugated box manufacturer like this, back to 16 or 15 price earnings ratios and go back to 130 or 140. So is PKG in a bubble or not? That's really to be decided. And can PKG stay up when there's all these attractive beaten down stocks outside the United States where rotations start to happen? That's the big question here, Terry.
Our chief equity strategist and economist, John Blank, on the Fed rate cut and inflation. With John, I'm Terry Ruffalo. Here's something you might want to check out. Zacks Insider Trader finds stocks so strong that company officers are pouring their own money into them. And you're invited to follow this portfolio's buys and sells in real time for the next 30 days. Go to Zacks.com/promo for details.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.